the teacher. Now we start. We start, guys. Good morning. So we're going to chapter 25, sources of external finance. In the previous class, we talked about internal finance, which means you're sourcing for fund within the business, either through the sales of assets, retained profit, or personal saving. That was the last class on internal finance. Today we're going to external. When we talk about external finance, it simply means we're sourcing for fund from outside the business. We call it external because the fund we needed is from the outside of the business. Not retained profits, not sale of assets, not owners' savings. So that's what external finance is. I wrote, it is the sourcing of funds from outside of the business. It means we're trying to get money from outside of the business. That is why we call it external finance. What are the sources of external finance? The first one, which should be the first anyway, is the friends and family. Those are the closest people you have. There are always ties between you people. So as soon as you have a business idea or plan, and you think of getting money from outside of the business, the first people that come to your mind are your friends and family. Yes or no? Yes or no?
Yes, of course, sister.
All right. So for friends and family, I hope this may be considered as the cheapest of all, as it is a form of loan, which interest may be lower or zero. Your friend might not even want to make an interest on whatever he gives to you or she gives to you. They might give you free, but you have to pay back. It's a loan, maybe low interest or zero interest. Do you get it? So that's why we consider it as the cheapest, because it's your friend. He or she might not even want to charge any loan on it, or interest on it. But the problem about friends and family is you have a stipulated time to pay back. If you don't pay back at that time, they might get angry. Hello? If you don't pay back at that stipulated time, the ties might get broken. The relationship might get, bad. Do you understand the point here? The friends, they trusted you, then they give you the money. But when the time comes to return, if you're unable to return back without a concrete reason, they might not be happy with it. Do you understand friends and family? Do we understand friends and family, please? The second one, banks. When we talk about banks, these are financial institutions. You can save your money there, and as well they can borrow you money. They can lend you money. So the point about banks is that they have a lot of cash to them, available to them. It's not like the internal profit internal source of finance that is limited. For banks, they are finance house. They are banks. They have a lot of money to give out. In as much as you fulfill the necessary requirements to get that loan. So you can have access to more cash with the bank. But the problem about using a bank as your source of finance is that you need to pay interest. And as well as the principal at the end or at the tenure that you are supposed to pay back. So for banks, you have the principal, you have the interest, which you have to pay yearly or monthly, mostly yearly. And paying that interest means your revenue would reduce because interest is part of your expenses. Do we understand that? Can you sit down properly and focus here, please? For banks, they lend you money. The money they lend to you is called principal. In the principal, as soon as you're going to pay off the principal, maybe after 4 years or 5 years, the whole amount you have to pay back. But that doesn't end there. There's interest charged on any amount of money they give to you. So the interest have to be payable monthly or yearly. So this becomes part of your expenses as a business. And because your expenses are increasing based on the fact that you are paying interest on loan, it reduces your profit. Do we understand banks here? Do you understand banks, please?
Yes.
The third one, P2PL, peer-to-peer lending. For peer-to-peer lending, it means you are trying to avoid the bank. So you are getting a loan from people, not the bank. You're related or not, it doesn't matter. But the point here is that you're able to get a loan from people who are willing to give a loan out via the internet. That is peer-to-peer lending. So what are the features about? Do we get peer-to-peer lending here? They give you a loan because they have it available to them. This is what they do. They give loans to people. In as much as they can trust you, in as much as you have a tangible project and you are convincing. Do you get it? So what are the features about?
Like loan charts.
What?
Like loan charts.
Yes. And also, but whatever loan they give, you have to pay interest to. But the interest might be just not the same as that of the bank, maybe 1%. Do we get it now or not? They give loans, but the point is you have to pay interest on it. But the interest is not going to be as much as that of the banks. Do we get it or not, please?
Yeah.
So let's look at the features anyway. The first one, past relationship of borrowers are not needed. They don't have to know you. You don't have to have a relationship with them. The only point is you making your proposal and being able to convince them that you deserve that loan. That's the first point. Is it clear, please? Is it clear, please? The second one, all transactions are done online, so it's via the internet. The third one, loans are unsecured, which means the lenders are not safe. So whoever gives you money, it means the interests of the lenders are not protected. Why is it not unsecured? It is unsecured because you don't have to get it with a collateral. You don't need a property, you don't need an asset to get the loan. It's just based on intelligence or how do I put it? Information of who you are and trusting that you will pay back. It is an unsecured loan, which means the lender might even lose out the money. Do we get the point here? Do we get it, please? And the next one, the interest rate is not high compared to the interest rates of the banks. The interest rate is not high when you compare it with those of the bank. The bank will charge you 3%, but for peer-to-peer lending, it might be 1%, even maybe 0.5. It depends on the amount, the volume of that cash you needed, or the value. Is it clear, please? The next one is the business angels. Why do we call them business angels? They are angels because they have funds available. They have surpluses, and they want to use it. They want to ensure that they go into a business which is not, they are not the brain behind. Theirs is just to put money and have stake in the business. You have the business idea, you have the mindset, you've started the business, but they can help you with funds. In return, they have stake in the business. Do you understand business angels here? Your business is ready, it's there. But for them, what they do is they help you with finance. In return, you give them certain stake within the business. So which simply means both of you will have the business. So they become a partner to your business.
Like a sleeping partner.
Yeah, we could call them, no, if we call, that's partnership. When I talk about partnership here, partnership starts together. It's a partnership business because we all come together to have the same mindset to start the business. But for peer-to-peer lending, it's a source of finance, which means the business is already there. Stop that already, please. Which means the business is already there. I only have fund available, maybe because there's tax relief, or probably because I have interest in that business. So I only have to give money to be part of the stakeholders, to have a stake or to be part of the owners of the business. But for partnership, we all come together to set up the business with the aim of making profit. Which capital will be almost the same, profit will be shared amongst them based on their deeds of partnership. So it's not partnership. Partnership is a form of business. Here we're talking about a source of finance. Do you get it?
Yeah.
And when we talk about a sleeping or dormant partner, it's that partner that has invested in the business but does not take part in the day-to-day running of the business. That's a sleeping partner. Then the active partner is that individual who works in that business and at the same time invested in the business. That's partnership. I think you understand partnership. Partnership is a form of business, but here we're talking about a source of finance, which partners might also use. Is it clear now, please? Great. So what's the problem about this? The problem about using business angels is that those business angels might have interest that does not go in line with yours. So if your interests are not the same, then there will be conflict of interest, and a problem might arise. Do we understand? You all have to be in the same page. That's it. You have to be on the same page. They need to have the same interest as yours. If not, if they have other interests, which is not the same as yours, then there might be problems. Do we understand business angels here? And the last one, crowdfunding. When we talk about crowdfunding, it simply means we're gathering large numbers of people to contribute small amount of money for a project. So I have a project but I cannot finance it. So I could talk to some bloggers, I could talk to some fund specialists online, and they would want my proposal, and as soon as I show them my proposal, If they are convinced about it, then they can put it on to their followers to start contributing. Do we understand crowdfunding here? So crowdfunding simply means we gather large numbers of people to contribute small amount of money to execute a project. But the problem about crowdfunding is this. If we need $5,000, and if the crowd are unable to contribute $5,000, then the money will be returned back to the contributors. Because it cannot fulfill what is needed for. So they're not going to give it to you. Because if they give it to you, you don't have other source of finance. That is why you come to them. So if they are unable to contribute that amount needed, then you cannot do the project. So they give back the money to the contributors. Do you understand? Do we understand crowdfunding here? So these are all external sources of finance. Thank you.